Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive right in, take a look, see what's going on today. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com, where I dive deeper into all these sectors, topics, looking for investment opportunities, sharing those opportunities with everybody in the community. Yes, I look for speculative stuff. Yes, I look for cash flow. Yes, it varies on a wide array of risk profiles. So I give the opportunities out there. You guys decide what you want to do with it. I do provide a little bit of guidance on what I would do in terms of portfolio allocation size to some of the opportunities and the risks and the way that I view the company and the risks that it has. If that's something you're interested in, special is the coupon code. You type in special in that coupon code, you get 50% off the first month on a monthly membership and a $100 discount on the yearly membership. If you can always swap from a monthly to a yearly if you'd like. So in gold we trust, commodities versus stocks. This is the Bloomberg Commodity Index versus the S&P 500 ratio. Shows clear super cycles. 70s was an 11-year bull run. So there's the 11-year bull run. In the 80s and 90s, we had a very large declining interest rate environment. Very good for financial assets. That's the 19-year bear market for commodities. The 2000s was a bottoming pattern. If you look at a lot of the charts, like here, we'll bring it up. So we can look at gold to M2 money supply. That 2000 to 2011 is in a bottoming pattern. That's what this is right there. The big 70s bull market, it came from way down here, which is like, well, let's put it, let me see if I can get a little bit more. If we use XAU USD, we might get a little bit more. There we go. So it came from all the way down here, which was basically coming off the gold standard, but let's just call it a big bottom there, right? And then we had a big bull market for precious metals. When we draw this line across, this is a pattern. It's a bottoming pattern. We call it I call it a double bottom. Sometimes I call it the booty, the double bottom booty pattern, where someone is sitting down and you got the cheek and the cheek. Yeah. Well, that bull market was this one here. It was a part of a bottoming. So this is a bottom here. This is a whole big bottom going on. And we haven't really broken out of the bottom yet into what could be an aggressive, very big bull market. Just like the 1970s. Do you know what the difference was between the 1970s over here versus this? This one occurred in a declining interest rate environment. This was at the end of an increasing interest rate environment. What's coming is going to be similar to what I think is going to be the big move during an increasing interest rate environment. That's a big deal, what I just described there. I'm describing the market conditions. So this 9-year trend here, where we saw this outperformance, that was still in a declining interest rate environment the entire time. We had another very large 13-year bear market for commodities. We bottomed in 2020, and I think that this is going to be a double bottom with a slingshot. What does that mean? So what I think is occurring is this side over here is going to be a double bottom, but see how this one is lower than the left side? I think this is going to slingshot upwards. What that means is that we're going to see a dramatic outperformance of BCOM versus the S&P 500. And the reason I say a slingshot is whenever it goes below this bottom here, just like we pulled back, it's like pulling back a slingshot before it gets released to the upside. So we'll see if that occurs and that actually plays out. But in my opinion, I think that this is going to be a bottom in here and that we're going to slingshot way on up where commodities could go up substantially. And that deals 100% with the market conditions. An increasing interest rate environment where money moves away from the bond market. That's why interest rates go up. And I think it's going to impact the stock market here at some point soon. I can't tell you exactly when, but soon. Eric Yoon says, just a reminder that BJ Milkshake relentlessly made fun of silver stackers for the last 5 years and called silver stackers pilgrims when silver was at $25 a troy ounce. Silver and miners are not part of BJ Milkshake's core position. Milkshake simpletons got financially screwed by listening to BJ's constant mocking of silver and miners. So silver making its fifth annual pilgrimage above 25 and everyone loses their mind. That was back in 2024. I'm not in this camp. I don't really care. I've been buying silver since 2018. So 28, well, I had some before that too. It wasn't nearly the same amount, and I really went into it 2018. I bought a bunch in 2020 as well, and a little bit thereafter. Uh, in the low 20s as well was a pretty good spot to be buying. But these people who constantly make fun of other people, it's not really making fun. The ones that don't believe the bull market, they're just victims of the market conditions. They haven't, in my opinion, they are victims of market conditions. They A lot of people try to go and chase price performance. Not saying that BJ Milkshake is, but most people do. And I don't prescribe to it. I just try to use logic. If I have to wait 4 or 5 years for the largest commodity bull market to, let's just say, transpire in my favor, then I will do that. There's no reason I should be anywhere else. If that's where the best value is, then that's where I'm going to be. And I'll just accumulate in that time frame. If someone was buying commodities in the late 1960s and they were early, who cares? It doesn't matter because if you played the commodity bull market from bottom to top, or even close to the top, you beat anything anyway. Even if you blew the first couple of years, it just doesn't matter. And I think that's where I get kind of annoyed with a lot of people. Not like regular people, but just when I listen to people, it's like they need to be in the best asset all the time. It's like you can't do that. That's impossible. Because a lot of the times the best asset is risky as hell. And if you're going to go and take on that type of risk, it isn't worth it. Because at some point you're going to get blown out. You're going to get blown out. It doesn't make logical sense to go buy something that is way overpriced, hoping that the price goes up. I mean, that's not a good strategy. It hasn't been one that has worked out well for many people in history. I mean, that's why I don't do technical analysis only. I don't like it because all you're hoping that it does is that other people will buy your crap. That's all it is. Now, if you are in a company and it is way overpriced, I mean, yes, it could go up more, and yes, it could be the top performer the next year. It could. But it can also get cut in half and get a major nutsack kick multiple times. That's what a top is. And you may never be able to recover, at least from that stock. Again, you'll have to sell it and go to and move to something else. But if all you're doing is chasing price, most of the time you're buying overvalued assets because that's why the price went up. It goes from undervalued to overvalued, and then everybody chases in when it's overvalued. So, in my opinion, with what I know and the ratios and the chart patterns, silver is probably one of the best potential asset buys during this guy making fun of it of any asset in the world ever. And it was probably the best risk reward opportunity of almost any asset in the world. And yes, there's a couple. Platinum is one, silver is another. There are a few. And in the metals, you have no counterparty risk. It is literally the least risky thing that you can buy. And you could have purchased it at the cheapest it's ever been against almost any other asset class that you put it against. Bonds, you could put it against financial assets, you could put it against anything. You could put it against house prices, probably silver's way cheaper. I haven't looked at that ratio, but I'm sure it was very cheap. So he's over here making fun of people who bought the absolute bottom of the best asset class with the highest risk reward opportunity in existence because there is very little risk and it's got a lot of upside potential. So be careful who you listen to on YouTube, guys. When I started my channel in 2020, the reason I started it in 2020 is because I was telling people at work that the people on YouTube were wrong. And they were like, if you know so much, go start your own YouTube channel. I said, okay, I will do that. And I started it at the beginning of the commodity bull market because no one believed that we were at the beginning of this big commodity bull market. They were like, yeah, right. It's like, okay, fine. I'm going to start my channel at the beginning of the commodity bull market for 2020. It was August of 2020. I went and I purchased oil stocks in front of everyone. You can go back and look at my posts. I was buying uranium in October, November of 2020 of companies which I still own. And I'm just riding this thing. We're in a big super cycle. Nobody believes that we're in a super cycle. Nobody believes that these assets are worth, anything there. I got made fun of. People would say, Kathy Woods thinks that oil's going to go never going to go above $30 a barrel. And I just thought everyone was so dumb to say any of these things. I'm like, this doesn't make any sense. It's just the cycle going back and forth. Coming down, what mining stocks will 10x the fastest and why? Well, I don't know which ones will 10x the fastest, but I could guess. I would guess it's ones that just recently have broken patterns and ones that are going to move up with some momentum here. If I were to take a guess, I think that some silver mining stocks could do very well. I think some lithium mining stocks could do very well. And maybe there's some rare earths or something like that that could also. We saw MP Materials. We were invested in that on the website. Some of us invested in that, and that is probably close to a 10x and one of the fastest ones. We had a couple companies that did 100% in a single day, and that's a stock that we were we have money in. So that's probably the fastest it's ever done for a 2x. So it's really it's part skill, part luck is what it is, and that's really what you need if you're trying to do it the fastest. A better question is not the fastest. The better question, I think, is which stocks will 10x during the bull market that have the highest probability of 10xing? Like which stocks have the highest chance of being a 10 bagger or something around 10x? And those are the companies that I seek out. So I'm not so worried about how fast it does it because usually the fastest ones are these small little speculative companies where money flows in and then it just deflates right after. The ones that I want to be in are the ones that I can hold for a really long time, but also have upside potential. They've got the juice to really move, but I don't see that downside. The downside comes with speculative companies because money flows in and then it flows out. In a legit cash flow company, you might see a company who's buying back shares just continue to walk higher. Those are the ones that I want to overweight. I don't want to overweight the ones where it's feast or famine, where they get 50, 60, 70, 80% pullbacks in a bull market. I want the ones that go up. They may not go up as quickly, so it's not the fastest, but they are the easiest to actually ride to a 10x or more. And then they've got the juice to continue to get squeezed to the upside. So maybe they can go 20x or 30x even. The economy is running hot. Why are we cutting rates again? Because we have a lot of debt and it's expensive. And I don't know if the economy is running hot or not. What they do is they print more money, they understate inflation, and then they overstate GDP. They can just make the numbers say whatever they want. So, and it's a psychological game that they're playing. So what they could do is they could say, you know what, we want to slow down inflation, but in order to slow down inflation, we need to slow the economy. But if we slow the economy, then everyone's going to see that we are in a recession. So what they do, in my opinion, is that they are slowing the economy. They're trying to run the economy slow or try to slow it down. And then they overstate GDP by understating inflation. So they're trying to inflate the debt away, at the same time trying to slow the economy down with increased interest rates, and then overstate GDP, so they play the psychological game. So now everyone's confused because you look at the data, it's like, well, inflation's way higher than what they're stating, which also means that GDP is way lower. So when someone says we're in stagflation, they're probably right. It's just people are looking at things from a nominal perspective. The stagflation is seen when you do the S&P 500 divided by gold. Gold, someone made a comment about my copper to gold ratio. They said this makes absolutely no sense. There's no reason to do this. Well, I would say yes, it's copper inflation adjusted. That's why you price everything in gold. You can't price anything in dollars anymore because you don't know what the real rate of inflation is. Hell, we probably aren't even going up in the S&P 500 at all. It's just the dollar going down. And you're making zero purchasing power gains when you price it in the S&P 500, when you price it in other things. So it doesn't matter what dollar value you get back. What matters is what you can purchase with the S&P 500 in the future. And that's the whole reason I do ratios. If you can't buy more oil, if you can't buy more gold, if you can't buy more silver, then be invested in those other things. And then eventually you want to be invested in things that can increase its purchasing power over time against mass-produced products. That's it. Brandon Balo says coal is officially in breakout mode relative to the SPY, the S&P 500. The revenge of the coal economy is upon us. We're playing coal hard on the website. And yes, it's breaking out, and we are going to make, hopefully, a good chunk of money here. Good chunk of money, because I think we're entering wave 3 in Elliott wave theory. Tim Hack, he says, remember when I called the gold to silver ratio crashed right at the top? This was just a massive and engineered fake breakout to the upside to mentally break the crowd. What will happen now is that the upward momentum that the fake out had will turn into downward pressure. Get prepared for silver to outperform heavily. I agree with this. This is a fake out before the breakout. So they fake it out and then they turn it and slingshots in the opposite direction. A lot of this has been going on, and they know a lot of people read charts. There's a couple of weaknesses that people have when they invest. One is they don't understand the market condition. All they understand is the chart pattern. And a lot of the times there's a ton of fake breakouts where it fakes out in one direction, gets everybody positioned left, and then it breaks right and slingshots in the opposite direction. And that's a bunch of people doing short covering. So what you need, and I know this is very difficult because the patterns are valid, but people get scared out of it. That's where you have to adjust yourself. You need to understand ratios, market conditions, and technical analysis, and then you got to see an alignment. So I've been of the paradigm that commodities have been bottoming since 2020. So I'm a buyer in commodities. Silver is going to outperform gold at some point when the market condition changes from safe haven to more inflationary. And that's already occurred. That's why it's going down. And now we're going to accelerate. So you have to tie things behind the technicals to get a higher probability of success and be able to buy these bottoms. That's how you do it. For dry bulk, we've got Capesize and Panamax are both down 1%, and tankers, VLCC is up 1%, Suezmax was flat. Speaking of this and shipping, a few changes in the VL market yesterday with benchmark rates on MEG Asia holding near WS 100 USD 90,000 a day. October bookings are well underway in the MEG, but plenty remain, which should support activity. So they're getting real good pricing here for the tanker market. Mike says, what happens to uranium equities when spot price makes a sudden $10 jump? They're going to go up, and they're going to go up massively. It's not about making predictions. It's not. It's about being able to position when people are accumulating and your risk reward is the best. And then you sit and you wait for this opportunity. So someone says, how do you buy 25% up moves? How can you be invested before that? And it's not about timing it. It's about buying it when others are accumulating and then being patient enough for others to recognize price movement, and then they FOMO, fear of missing out, into it. So I've been in uranium for a while. I've purchased at pretty good pullbacks, I would say, and I just sit and I let it float me on up. And if we get a $10 jump, great. I make a bunch of money then. It's perfect. Several industrial metals are on the verge of breaking out of long-term base consolidations. Breakouts will probably complete the base on the BCI that we have been discussing in the Global Equity Markets Report. I will discuss more about these trends in it today, and there's a double bottom. You generally get resistance right here. This is basically like, oh, it's palladium. I was going to say it's palladium. And then you get a pullback, and then we're going to break out here. And there's a whole bunch of other metals that are very similar to this that are going to be breaking big patterns like copper. Zinc looks very good. There's a whole bunch. Nickel is bottoming and ready to break out. There's a wide variety, and there's opportunities in every single sector of those. Now, some people will say, well, what sector is going to do the best? Wrong question. The right question is, what are the best couple of companies or vehicles to play each of these sectors with? Ding, ding, ding. Why is that better? Because you're not guessing on which one will be the best. And also, if you guess wrong, you have a more likelihood of FOMOing into another sector. So what you want to do, in my opinion, is you want to buy a little bit of each of these sectors that look incredibly good. You buy the best few companies in each, and you just let it ride. It'll smooth out the portfolio, and it will also increase capturing those returns and not having the likelihood of fear of missing out if one takes off before another. So again, a lot of this is psychological and emotionally driven, where you need to handle your own emotions. You need to handle your own psychology, and you're not likely to start buying and selling at inopportune times. This is Grady. URA is now breaking out hugely versus the S&P 500 from a very symmetrical blue 9-year inverse head and shoulders pattern. Uranium miners did a 580% move in its baby bull move. Still is just getting started. Next phase is now starting. The glorious commodities bull market will be the greatest opportunity in your lifetime to get out of the rat race. As said now for 5.5 years, do not miss it. So this is it. We have money flowing into URA versus the S&P 500. We've got a breakout. It's game on. Now, this is the time to look at the portfolio. Make sure you are positioned for this move and look across to make sure you've got the companies that you want in it. Maybe you've got an ETF, maybe you've got two ETFs, and maybe you've got some individual companies to play this. How do you know which one's the best? That's what I go over on the website there. What are the best ways to play this? What are the best companies? Why? How would I weight them? And then you can see what I'm doing for it. But these opportunities don't come but once every 30, 40, 50 years. That's all you get. You got to play it very, very well. So I'm playing this, and I bought it here in 2020, and I've been riding this, right? And I think this is wave one, and this is wave two pullback, and we are entering wave three here, which is going to be a big, big wave. So it looks very good. I'll say this one more time. When oil soars, stocks sell off. It's an algo thing. Okay? So this guy, I read this, guys. This is disaster here. So let's go over it real quick. He says, I took out a $50,000 personal loan, hoping I could double or triple it, pay off the debt, and still have plenty left. Instead, I ended up losing it all. The most painful part is that I actually had some amazing positions that would have tripled my money or even more, but I sold too early and held on to the losing trades. Now I'm sitting on $50,000 of debt, feeling devastated. What do you all think I should do next? Is there still a chance to recover? Or should I just quit trading, focus on paying off my debt, and move on? Any advice would be greatly appreciated. This is what his portfolio looked like. He went from here to straight down. Now, in order for this to occur, that's probably options trading, is my guess. And that's not what you want to do, in my opinion. So, what advice would I have for a person in this situation? Number one, I wouldn't have taken that debt unless you know what you are doing. Now, if you know what you are doing, you are still susceptible to getting your butt handed to you. So, what I would do is I would learn a different strategy, because this right here is a joke. You should never have this type of move in your account. What that means is you are taking on far too much risk. What you should be doing is seeking help. How can you learn the market before doing this? This is a gambler mindset. The gambler mindset is you start to lose a little bit of money, and then they will get more, they'll just pile on the risk until they lose everything. What you want to do is you want to learn the market first. You need a mentor. You need somebody to show you how to do it. Then you get a strategy down. You get position sizing. You learn how to handle and manage risk. Then you get experience. You don't get experience by just dumping $50,000 of debt right off the bat. That's not what I mean. That's not what I would do. What I would do is I would get good. You know when things are risky. You know when and where to purchase. A great deal of handling risk is where you purchase a stock. And for some people, it's like a light bulb going off when I say that. They're like, what do you mean? Where you purchase a stock and the value that it has is handling risk to a certain degree. It's a big portion of it. It's risky. So you can have the same exact stock that at one point is low risk and at another point is high risk. And it's the same company, it's the same stock. But the only thing that is different is the price that you pay for it. And I just gave a little bit away to everyone who's viewing, a little bit of one of my strategies, a little bit. So he needs to learn. That's what I would do first. The oil to gold ratio is now 6 standard deviations above its long-term trend. 6. Opportunity. That's what's called handling risk. Looks good, doesn't it? And that's where we're going to end it. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website, especially with the coupon code. We have a Saturday Q&A session coming up this weekend, 7 a.m. Mountain Time. So if you're going to attend it, that's when we're holding it. Make sure that you have your questions ready. And if you can't make it, it gets recorded and uploaded to the website so you can still view it. All right, guys, that's all I've got for today. We'll catch you next time.